Hi, this is Larry Gaines from PowerCycleTrading.com. Well, the markets like the Fed, what they did today, so everything was, came out smelling like roses, and the market's got a great rally. But in this trade setup, I want to show you one of my favorite trades. This is what we call an iron condor, a long iron condor. So basically, what we did here, this was an earnings non-directional type trade setup, and this was on Apple. So the initial trade setup, we were looking for a move to be either greater than about 3.5, 4% higher, or 3.5, 4% lower. So we just needed to set this trade up for a move on Friday at above $160 or a move on Friday at below 150. So if that was the case, then we'd have a maximum profit, be about a 25% return based on the way we set it up. But the thing that's really cool about this type of structure, this is you can, if you know how to do this kind of construction or adjustment, whatever you'd like to call it, it can turn a trade into a free trade with really fantastic, still upside potential. So this was set up originally as, like I said, an iron condor debit spread. So we need to close on Friday above 160 or below 150. But then with this spike to the upside today, gave you a couple of really great opportunities to make some adjustments to reduce your risk on the debit spread side of the iron condor debit spread and reduce it, but also lock in some credit. So let's take a look. So the original trade was yesterday set up going into the close was buying the 157.5 call, selling the 160, and then buying the 152.5 put, selling the 150. So we have this construction here. So this is what we call an iron condor debit spread. So we've got a maximum potential risk with this structure of $192. Now, if it closed on Friday above 160, you make $58. If it was to close below 150, you make 58. So that's about a 30% return. But the thing that you can do is with this, having enough time until the end of the week, we had a nice spike up here you can see today. And so basically what happens now, the put debit spread is worthless. Okay, that's at zero, but your call debit spread is now worth, over 150. But look here what you could have done. You could have two different adjustments. You could have sold the out of the money 165, 167 and a half bear call credit spread here for over $1. All right, so now your net debit at risk is 94, but you could bring in another $1 here by selling the 165, 167 and a half, $2.50 wide. All right, and now we've got this beautiful construction. We've got what is called a long call condor. So we're still long the 157.5 call, short the 160, but we've added a credit spread up here, the 165, 167, and it went out at right here at 165.35. So this is adding an additional credit spread, but if it was to keep going straight up, zero risk. If it collapsed down, zero risk. But if it goes out in this window, let's say on Friday, which would be the perfect scenario, if it goes out here and is trading here Friday at 165.50, this trade will be up $167. If it was to go up here between these strikes here, this trade would be up $257 and on zero risk. So that's one great adjustment that you can make if you just know what to look for. Hope this helps. And if you'd like to learn more, join us for a free webinar this Saturday, and I'll be talking more about these types of structures. Good luck trading.